speaking of corporate bonds, is there any level of diligence that is done at the back end before releasing them on your platform, or you are just listing all the bonds that are there in the market? How do you assess their risk?
So first of all, we are not a marketplace.
Now, speaking of bonds, do you sell them at a markup?
Actually, also put in more money from our pocket to sell it because you want to create awareness.
So what is the average amount of FD that we have booked?
On an average, I have...
Today, we have Mr. Saurabh Jain with us, a graduate from IIT Bombay and a prominent figure in the Indian fintech sector. Saurabh co-founded Stable Money with Mr. Harish Reddy with a vision to revolutionize investment strategies in India by offering seamless fixed return investment solutions. In this episode, we'll explore how Stable Money is using technology to simplify investing, educate investors, and ensure a seamless user experience. Hi Saurabh, it's a pleasure to have you here. So I'll begin with my first question, that is around what was the idea of starting Stable Money and what are the current offerings at Stable Money?
Thank you so much, Kanan. I'm very excited to be on the show. Before answering your question, I have seen so much of work that you guys have done on the One Finance magazine, on the podcast that you're doing right now. I think it's really educating the customer base. On FDs, I think what we realized during my time at Navi Mutual Fund, right, and I'll give you some anecdotes, is that when we were launching NFOs of Navi Mutual Fund, we realized that customers are buying NFO and selling it on the first day of launch. And that didn't make any sense for us. Because I said, yaar, there is no gains. Why are you doing this? And when I started calling a lot of customer base, I realized that these are the customers from tier 2, tier 3 cities. And they said, sir, day one pe to gains hote hai. And they were confusing NFO with IPO. And then I realized that a long tail of India, right, forget what we keep hearing in our big cities, the people around us, where we keep talking about mutual fund stocks, real estate and all of that. The large part of India doesn't invest in that, right? We know when we were doing Navi Mutual Fund, is only 3 crore mutual fund retail investor. That's growing, but still the amount that they're doing is much lesser. अगर आप active customer base देखो, you will see that mutual fund and stock broking would have mostly 5-6 crore investors, retail investors who are active. And if you look at FD, you will realize there are 19 crore retail investors who are doing FD. And the best financial product always is the product which has passed the test of time. And FD has passed the test of time through so many cycles in the last 50-60 years. That makes a lot of sense for customers, right? And we said that in the last 4-5 years, where there is a massive inflow of retail investors coming into the capital market, because if you enter at any point in time, your gains were positive. Up peak par bhi lo, I think you would always see a positive returns. But in the last couple of cycles, and especially now, people are realizing that's not true. You can't have all your eggs in one basket. And these are some of the people, because of the greed that generally anyways in human nature, that people got into capital market without realizing what is the risk that exists in this, right? And as soon as they saw negative returns, they churn off the platform. And then what is happening is getting them back into the capital market is very difficult. And that's where we realize that this is not the great segue to get customer into building the nation, right? By doing a capital market investments. We realize that in the last 4-5 years, there is so much innovation that has happened on the mutual fund and stocks, right? And no innovation happened on the debt segment, especially the segment which is FD, which is so popular. There are 60 lakh crore in retail FDs that exist. It's still growing at 8 to 10% year on year. It's a massive scale, right? We have added maybe 5 to 6 lakh crores in FD in last 1 year, where we must have added mutual fund with 1.4-1.5 lakh crores from retail customers, right? Despite all of these people talking about inflation and all of that. So we see that there is a great opportunity to build wealth for the retail customers, but that's not getting these users directly to the capital market. That's getting these users to upgrade from what they are doing to their comfort product, but with the innovation. And that's why we started with fixed deposit. We realized that people, only 1% of India's FDs, so there are 25 crore FDs in India, only 1% of the 25 crore FDs is earning more than 8%. That's the data. Now you imagine that if you move that 1% to 5%, 10%, how much additional $1 billion of wealth that you can create for this retail segment. And that's where we realize that there is a great product to be built. A lot of innovation can be done on this by getting FDs onto a platform, so that a user can migrate from a 6.5% FD to 8.5%, 9% kind of an FD with the same risk. So that's how we thought that in this fintech era of everybody talking about capital market, you can actually break the clutter and build it for that long tail customer segment who really believes in FD, who is also believes in saving a little more, where this 2-3% of delta will make a lot of sense for them.
So apart from FD, what all products are there on your platform as of now?
So we started with FD, Kanan, almost 16 months back. August 2023 is when we launched FDs. And just a couple of months back, we have started doing government bonds and corporate bonds onto our platform. It's still in a beta phase. We haven't opened it to all. But yeah, so these are the two products right now that we have onto the platform.
Got it. So speaking of corporate bonds, is there any level of diligence that is done at the back end before releasing them on your platform, or you are just listing all the bonds that are there in the market, or where you get them in the primary market? First of all, how does it happen? Do you buy directly from the companies? And second, how do you assess their risk, whether they should be listed on your platform or not?
Got it. So first of all, whether it is bank or whether it is bonds, we are not a marketplace where anybody can come and put their product. We are a curated marketplace. So we are not a transactional platform versus what you see for mutual funds and stock, that all stocks are listed, all mutual funds are listed, you come and do this. We are a very curated place. So when it comes to FD as well, we do our own diligence with the bank, how the bank financials are, which banks to be onboarded. Obviously, there is a larger safety of DICGC insurance that exists for every bank. Similarly for bonds, because we understand very clearly that bonds is a slightly complicated product for customers to understand, and they have built trust on stable money because of FD. If I put any bond, some of these users would buy. But we want to ensure that this doesn't remain a marketplace. This is a curated marketplace. So that's what we are doing. There is a credit rating that already done by CRISIL and other credit agencies, and we use that credit rating as our primary source of truth. Then we work with a lot of companies. We have our own risk team to assess the risk of that particular corporate bond before putting them onto the platform. In terms of how we source, we are still a very, very small part of the overall bond platform. We believe right now it doesn't make sense for a company to give us a primary issuance. So we right now source it in secondary and pass it to the customers. Our eventual vision is that once we have a larger scale, we go to the companies that we like, do the assessment right in the beginning, and get it into the primary issuance. That will, in that ways, you will be able to pass on a larger value to the customers back. Because now, because there are secondary transactions happening, obviously there is only smaller value that is getting passed on to the eventual customers.
Got it. So right now you are buying bonds in the secondary market in your own book, first of all, and then selling it in turn to the customers.
Yes.
Is that correct?
Yes.
So there is an inherent risk of not being able to sell those bonds. So how do you mitigate that?
See, I think there is a risk, but it's not like from day one we are trying to do this. We are trying to build our book very slowly, and that's why we are still in a beta phase where we are launching it to the customers. We are doing some experiment in terms of how it works, which kind of bond sells, who is buying that bond. So we haven't exposed our entire book and taken a lot of secondary bonds onto our book. It's a still very, very small part of our overall treasury that goes into bonds as well. And as we are gaining confidence month on month, as our volumes are going up, we will expose only that much book from our treasury to the bonds.
Got it. Fair enough. So what is the value that customers get by purchasing bonds or FDs from your platform vis-a-vis buying them directly from the banks or the companies or even the exchanges that are there?
See, I'll talk about FDs. I think FDs because as I've told in the beginning that there was no innovation happened on this product, because something that exists for so long, people just generally forget about it, right? And that's where the larger opportunity lies. For example, one small example is when you have to open FD in any bank, what is the way to do it? You'll have to go and open your savings account with that bank. Once you open a savings bank account, either through the physical branch or through the net banking, you will have to transfer the money to your savings account, and from that savings account you will have to book an FD, right? And now with taxation, all of that, rules are stringent. Managing so many savings account is painful. So that is one problem. Second problem is discovery of bank is very less. What I understand is in my vicinity of 2-3 kilometers is wherever there is a branch, I'll have exposure to that, and I'll most likely be going to those branches or booking FDs in those banks. But you don't know there are so many banks that exist in India which are offering much better rate, but just because you don't have access to that, you are missing out on returns. And then there are multiple smaller innovation that has happened on fixed deposit, right? Like for example, people still don't know if you prematurely withdraw your FD, what is the penalty charged by the bank? Even when you go on to the net banking, you will see that once your FD is matured and withdrawn prematurely, is when you realize how much penalty is being charged. So there is a lot of concerns around the transparency as well. And what we have done is we have picked this problem statement in this order and tried to solve it. So now on stable money, when you book an FD in any of the banks that we have, you don't have to open a new savings account in that bank. You can directly do the KYC onto the platform, transfer money from your primary savings account to that FD account, and once that FD is closed or withdrawn or matured, that account gets automatically closed. So you don't have to manage multiple savings account with that. Second is we have completely digitized the process, where right from identifying which banks that you have to invest, what is the different tenures, doing the KYC which is done by the bank, doing the video KYC which is done by the bank, to tracking, to withdrawal, to getting that FD receipt. That entire process is done on the stable money so that you don't have to visit a branch at any point in time. And third is transparency. In terms of what are the rates, let's say for example, you go to top 4-5 banks that exist in India and go to their website and try to find the fixed deposit rates. You will realize that you will get, in most of the banks, you'll get a PDF which says rates 7 days to 49 days, 50 days to 61 days, 359 days to 941 days. That's how the rates are communicated. This is not how we consume data, right? You say कि मेरे को 1 साल का FD करना है, 1.5 साल का FD करना है, identifying that best rate. It's very tricky. If the rates change, users don't get to know. We have simplified that to a larger extent, where you can come onto the app, not only find rates of the banks that we offer FDs for, but we have also collated FD rates for all the 200 banks, top 200 banks that exist in India. So that I can easily find the rates. You would quickly do the calculation, if I want to invest this much amount for this much tenure, which is the best bank to invest in. And if you want to prematurely withdraw, we do all the calculations for you, saying that that when you prematurely withdraw FD, I'll give you an example, right? And nobody knows this. Even before we started FD, we also didn't know how the premature calculation works. So maybe just for the audience, we can give an example. Is let's say you book an FD for 1 year, and the rate of that FD is 8.75%, which one of the banks offers on our platform. Now, when you prematurely withdraw at 6 months, people think that you will get half of that return, and there is a penalty of 1%. But that's not how it works, right? Logically, so when you break after 6 months, what bank will do is the day you book that FD, at that day, what was the rate for the 6-month FD? Let's say that will be 6%, right? So you'll get 6% ka adha, which is 3%, and then there is a penalty of 1%. So you actually get only 2%.
Right.
But what people are thinking, I'll give around 3.5-4%, right? And nobody knows this. And this calculation is so complex. When you go to multiple branches also, people won't be able to explain you this. And that's why when I talked to my parents, they said, Saurabh, don't prematurely withdraw any FD, or we never prematurely withdraw any FD, because sara interest chala jayega. That is the misconception that people have, that you will start losing entire interest if you do that. Because maybe initially when people used to go to the branch people used to tell them like that. We give all of that transparency and calculation to them, saying that, okay, this is how it works. There are some banks on a platform which offer no penalty on premature withdrawal. So they don't charge that 1% penalty. There are some banks on our platform, when you prematurely withdraw FD, you get money instantly in your account, right? So a lot of people have started moving their savings account money to that, because you don't need that savings account money. You break it into smaller chunks, put it in FD, that will keep earning better return than your savings account, and whenever you need, you can just go to the app, click and get that money back. So that's how we have changed the landscape on this, and obviously a lot of credit to the banks in being open to making those innovations and doing that. So that's one thing that we have done. On bonds, see, bonds is very, very early into its journey, right? What has happened with mutual fund 5-6 years back, we believe that will now happen for bonds, because people are understanding the risk. People also understand that, okay, bonds is somewhere in between the mutual funds and the FDs. So there is a lot of tailwind that is coming. Regulators are changing the ticket size, making it more accessible to the retail customers. There, I think, other than doing some basic innovation that exists, like for example, bonds, people don't know, but bond comes into your demat account. So you need to have a demat account. You need to ensure liquidity, but because most of the bonds are generally 6 months, 12 months, 18 months, and if sometimes you have to get a liquidity, there is no process. So we are trying to do some innovations around that, on how the bond transaction happen. But we believe on bonds more than the product innovation that we have to do. There is more work that has to be done on the education side, that who has to buy bonds, which bonds are good for you, at what tenure, what rate you should buy the bonds, and what are the use cases for which you have to buy bonds, right? So that's our primary task on the bonds as a product versus some of the other products.
Got it. So are there any other offerings apart from bonds and FDs that Stable Money plans to come up with?
See, how we have positioned ourselves is initially for our customers, because we don't want to show any negative returns to the customers. And what we have realized for the retail segment of India, 65% of their wealth lies into fixed income investments, which is FDs, savings account, maybe bonds if somebody is doing bonds, gold, real estate. And we want to start with these products first, because that is where a lot of innovation is spending, a lot of digitization is spending. So we have started with FDs, we have done bonds, we are getting into gold as a product now. And why we are doing this is because, first, I strongly believe in gold as a product. Because agar ek example aap lo, a 1 kg gold 20 years back was worth one house at that point in time. A 1 kg gold today is worth one house, and 1 kg gold 20 years from now will be worth one house. That's the best product that exists, which beats the inflation, right? So you need to have good allocation of gold into this. Now you see what has happened in the last 7-8 years when SGBs were launched. It's a beautiful product that was introduced, but it wasn't making any sense to the government, right? So now they have stopped issuing the newer SGBs. Now after SGB is gone, what is a great product for you? Well, the great product is not a digital gold, because digital gold is not well understood by the customers, and everybody is just looking for the convenience of buying that 5 rupees, 10 rupees every day kind of an SIP for gold. But there are a couple of problems. First, they charge GST, right? Whatever returns you will get, you are fully taxed on that return. Third is there is a transparency issue on the prices. Buy, sell will always have a significant delta.
Right.
So that doesn't make any sense. And we are surprised that why digital gold as a business is growing so fast, right? Because I think the only emotional aspect there is people have a attachment to gold. Then which is a great product to do now after SGB is gone and digital gold is not a product? It's a mutual fund, gold mutual fund, because that is very transparent. The cost that exists on the gold mutual fund is significantly lower. It's again a very simple product, and it has a LTCG on gold mutual fund. But despite all of this, you will see that why gold mutual fund, I believe if I combine all the AMs, there are anyways only fewer mutual fund AMCs which offer gold as a product. And if you combine all of that AM, I don't think that's more than a 20,000 crores. And if you'll see, that's a significantly low AM despite the gold prices. And the major reason is because mutual fund was always sold and initially went through distributors and now to customers, and customers keep equity in mind. They don't think gold.
Right.
And that's what we need to change. That now, unless you're buying a physical gold for your needs, I think the only product that you should buy is a gold mutual fund if you're looking it for the investment or hedging or inflation. And that's the next product that is coming onto the platform that will take maybe around April. Maybe haven't spoken about it. This is the first time I'm talking about the gold mutual fund product that is coming. And eventually we want to get into the products like REITs and some more, but that's the plan for the next 12 months.
So, speaking of gold mutual funds, you will be acting as a distributor to the AMCs and not launching your own gold ETF or gold
Yes,
mutual fund.
yeah.
Got it.
Because the product exists, and
Right.
in this there is no innovation, because
Right.
everything lies on a gold ETF.
Right.
तो उसपे एक fund of fund है.
Right.
So you don't add much value other than
Right.
cost to this. So that's the fastest way for us to get into this.
In fact, speaking of gold, so in the latest edition of the magazine, we did one research for last 25 years across 25 emerging market countries to test whether their headline indices beat gold returns or not.
Yeah.
And only Nifty 50 did that.
Yeah.
That too, if we divide it by their standard deviation, it doesn't beat gold.
Oh, it's a beautiful product, and I think that story of, and if you genuinely ask me, I think anybody should have around 30-35% of their investments into gold. That's a large, but I believe it's worth it.
Since you spoke of allocation, let me ask you, how much of your personal portfolio allocation, let us keep stable money aside,
Sure.
stable money is equity aside, otherwise almost 100% could
Is
be
equity.
Otherwise, let's keep that aside. So apart from stable money equity, how does your personal portfolio mix look like? How much of that is in equity, albeit directly or through mutual
Sure.
funds or in startups? And how much of it is in gold and debt products and
Sure.
others?
See, initially, a couple of years back, almost 80-85% was equity, right? Because again, like anybody else, I was also thinking that that's the best way and it'll just keep going up. Second also, and that's why you will see that a lot of people in our primary circle still do a lot of equity, is because in their head and their entire parents' money or parents' investments is into FDs and golds. So it said ki yaar, okay, now that is hedged, let me put all of that money into equity. But there is a large segment, and now with these fluctuations, I have slowly moved from that 80-85% to now 40% in equity. 60% now, 60% of my newer investment is into debt. So eventually I'll hit that at an overall portfolio level as well. And in that 60%, I have 20% very liquid, which is savings accounts, 20-25% savings account, FDs and all of that. I've started putting 20-25% into bonds because that gives slightly better return than this. And then remaining percentage is into golds. REITs is something that I haven't done right now. But of that 60%, you say 1/3 in savings account and FDs, 1/3 in bonds, and then 1/3 in gold.
So speaking of REITs, are you planning on launching a small SM REITs, right?
Yeah.
Something like that, or you are going to sell REIT units? on
We
platform?
are initially planning to sell REITs unit.
Okay.
The products is little complex, the ticket size is slightly higher,
Right.
so we have to see how we will get this done. But
Right.
we believe that's a great way to get some retail money into real estate.
So apart from education, paperwork simplification, and all of the other things that your platform provides, what are some nuances and nudges that you keep in your app or your website
Yeah.
to make user flow seamless and make them understand the product better?
Yeah.
Like one example you gave, which was very good, that you are explaining them what are they losing out on
Yeah.
by withdrawing an FD
Yeah.
prematurely.
Right.
So are there any such more nudges, and how have you designed the user flow to make sure that they are well educated and they are doing an action, be it of buying or selling any kind of product,
Right.
by keeping this factor in mind, that what are the costs and benefits that they are going to
Yeah.
incur because of that?
See, I think one most important thing, because you are targeting the customer that believes so much in trust, is that you can't say a single line and then they say there is terms and conditions apply. Because most of these people are not like us. Like my parents don't understand how FDs work, even now, despite doing 30-40 years of investments. So what we said that we'll have to build that trust, and that's where we have started building these nudges. One important nudge that we have built is everybody talks about now, because of Yes Bank fiasco, insurance going up, FDs picking in the market, everybody talks about 5 lakh insurance. And when we launch our FDs, we realized that everybody is doing 5 lakh. And we started talking to customers. They said कि 5 lakh तो insured है ना, तो पैसा safe है. But actual rule by DICGC is 5 lakh of principal plus interest is insured. So that means if you put 5 lakh and if you get interest on that, let's say 30,000, 40,000 rupees, and that bank goes bust, you will still get only 5 lakh. You will not get your interest. So what we started nudging users is that you don't invest 5 lakh, you do 4 lakh 30,000, 4 lakh 40,000 depending upon the calculation in the tenure, so that on your maturity you will have entire 5 lakh. And if anything happens to the banks from now till then, your entire money is safe, you are not losing out. Plus anybody goes beyond 5 lakh, we nudge customers that okay, you should ideally diversify into different tenures. When the rates are going up and down, like for example, if the repo rate changes happen, how people think is whatever is the highest rate is where I'll go. And people realize, well, let's say on my platform 18 month is giving the highest FD rate. People will book that. But we also nudge users that once the repo rate falls, and every rates will fall, for the next 2, 3, 4 years, FDs will not come back to this number. Right. So it's important for you to lock in those FDs. So if let's say 9% you are getting for 18 months and you are getting 8.75% for 5 years, I would recommend user to do 8.75% because that's better. Another thing is customers and most of us realize that 8.75% is the return that you get. But for bank FDs, it's a quarterly compounding, right? So every quarter you will get 8.75%. That interest gets accumulated to principal and you will start earning interest on principal plus interest. So your 8.75% is actually maybe 8.9, 8.95%. So people don't understand how the compounding works. So I think these are smaller things that we have started doing. Obviously, is it easy? No, it's not easy because you'll have to figure out at multiple places where the customers will have the right attention and focus to do that. And second, it takes some time through product, through talking to the customers, through some of these educational podcasts to tell customer that how you should think about this. But what we have seen in the last 14, 15 months that anybody who has gone through this cycle and has seen some of these nudges onto the app, they have built a lot more trust onto the platform. So I think that's our goal, and this is how we are working through product to build that trust.
So, since you spoke about the DICGC insurance, can you tell me what is the mix of top 3 banks? Say, for example, if 100 crores of FDs have been booked through your platform, which are the top 3 banks or top 5 banks who have accepted these deposits, and which are these banks? If you can answer that.
See, when we launched FD to outside customers and to us as well, we always thought that if you have multiple banks onto the platform, the money will go to the highest interest bank. But when we opened the app, and now what we have realized is that's not true, because there are multiple factors that a customer considers before doing an FD. First is there are a lot of nuances in terms of the processes. Like for example, some banks give no penalty on premature withdrawal. A lot of customers prefer that because they feel that they will be able to, they want to prematurely withdraw FD because they might have a need. Some banks give instant money. So a lot of people who have kept money from their savings account into FD, they want to book into that. Some banks give greater interest rate for a shorter tenure, right? And some banks give obviously higher interest rate. So because of that, I think around 50 to 60% of my money doesn't go into the highest interest rate bank. So there is approximately 40% of the money that the FDs get booked every day goes into the highest interest rate bank. 60% has multiple other criteria for people to consider. Right now, because of the 10 banks, we have 2 NBFCs, and out of 8 banks, we have around 6 small finance bank, and their rates are higher and they cover the large spectrum. Most, like all my top 3 banks are the small finance bank that exist onto the platform, and together top 3 banks would be contributing around 60% of our overall AUM that comes.
Which are these? Are these small finance banks?
These are small finance banks.
Okay, so what will happen? Like, of course, there's a, like, since we spoke of the DICGC insurance, and it is definitely insured up to 5 lakhs, and you get that money within 90 days of the bank going into a moratorium.
Yeah.
But if we speak of the money beyond that.
Yeah.
While typically it has been seen that the RBI manages,
Yeah.
somehow manages to give the depositors money back,
Right.
right? But if we speak of PMC Bank for that matter, 5 lakh to mil gaya.
Right.
But beyond that, in installments of 50,000 and so on,
Yeah.
the investor, say for example, if someone had invested 20 lakhs in their FD or savings account or whatever,
Right.
they'll have to wait for until 10 years from the
Right.
moratorium date.
To
So,
get the money.
sorry?
To get the money back.
To get the money back, correct. So, there is an inherent risk in these small finance banks or, the smaller ones, because in a bad credit cycle, like we are seeing the NPAs rise, especially right now in the personal credit space, in a bad credit cycle, there is a big risk that these banks go bust.
Absolutely.
So, how do you plan on educating your investors
Yeah.
to, to be wary of these kind of risks and not lose out their money? Because for every 1% extra, there's slightly more risk,
No,
right?
absolutely. And I'll tell you, I've read this somewhere that there are events which has a very low probability of happening, right? Black swan events. But if you see at every minute, at every second, somewhere in this world, there is some or the other black swan event is happening. So you can't absolutely skip that. And I would not only limit it to small finance bank, what you said, and I'm absolutely in alignment with you, but I would do that for all the banks. I'll give you one example, and you will be surprised that Saurabh, you are running stable money, and how can this happen to you? My parents lost almost 35 lakhs year and a half back in a cooperative bank in Aurangabad, which we knew, which I knew from my childhood, which we knew the promoters and everything. And in my dreams also, I will not think of that bank going bust, but that happened. And obviously, because there's very limited understanding, there is full trust, they have put the entire money into 2, 3, 4 FDs, and they got only 5 lakhs out of that. Now, I'm just saying that there is a risk that exists in small finance bank, but there is a risk, you have seen Yes Bank and you have seen multiple other banks as well. There is a risk that can go upwards to big banks as well. So if you are FD and safe customers, don't only think that you have to keep the money less than 5 lakh in small finance bank. I would suggest that whatever is your deposit, break it into 5 lakhs. Even if it's the top 4 banks in India, I think you try and break it into 5 lakhs, because you never know what could happen. And it's not that, as you said, right, you get your money back. The problem is the stress that you go through over that next 2, 3, 4 years, the requirement that you have, it's your money, but you will have to keep going to the bank, keep asking them what is happening with my money. It's a very painful scenario, and I've seen that with my parents. It's their money and they have to go to banks to visit them and ask them when will the money come. So I would recommend not only to my parents, to you, to everybody who is watching this, is that however big is the bank, you keep your eggs in multiple basket, limit it to 5 lakhs, so that you are always having that peaceful sleep when it comes to money.
And it's as easy as investing. So withdrawing money is as easy as investing at stable money. Yes. I don't have to go to the bank.
You don't have to go to the bank, but we have all the checks and balances if you want to ensure, because it's FD is the most safest money. People will trust their safest money and they will do multiple checks and balances. You get instant FD receipt on our app. You will get FD receipts from bank. You will get SMS from the bank. The money directly goes into the customer's bank, the bank's bank account. So let's assume in hypothetical situation that 3 years, 5 years down the line, stable money does not exist. You don't have to come to our app to click that, okay, my matured FD, transfer my money. Bank will automatically transfer the money to you without us giving any instruction to the bank when your FD is matured. So you take that FD receipt, you can go to any branch near you and confirm that your FD exists. You can call the customer support of bank, confirm that FD exists. So I think these are the things that we have ensured, that bank has ensured, that RBI has ensured, that if somebody is booking through stable money, it has to be very clear, and that's our intention as well, that it's not that you are booking FD with stable money. You are just booking FD via stable money. Your FD is still with the bank. And that's the most important thing that we keep communicating to the people. That's why when the KYC happens, we say that you are connecting to the bank, because the entire KYC data lies with the bank. KYC happens with the bank. So we don't have any understanding on what is the KYC, what is the state of the user. So that That I think with the regulators and everything, that has become very clear that how do you ensure that though there is incremental returns, but safety is paramount when it comes to these investments.
From a technical standpoint, are there any challenges to integrate your software or your offerings with those of the banks?
Yeah.
And which are some other banks which you think you can onboard, which you have not onboarded so far, who have this kind of capability to integrate seamlessly on your platform?
See, I think when it comes to fixed deposit as a thing, they have been offering this product for such a long period. This product exists on a phone banking and a net bank in a very seamless manner. So, respect to only fixed deposit as a product, there is very less challenges when it comes to technicalities, because this system has been already built. There is a core banking system. On that core banking system, the entire KYC data, FD related, everything has been done very seamlessly. I think there have been some initial innovations that we have done when it comes to no savings account required, transfer money instantly to the customer's bank account. When somebody withdraws, there has to be no penalty. These are some innovations that we have done with the bank that took some time for us. But interestingly, what you will see, and I think you know it better than me, that most of these banks realize there is so much to ride on the digital innovation, that everybody has started building their digital innovation vertical. A lot of these people who are leading these digital innovations have come from the digital businesses that they have done in the past. So there is a different mindset that exists now in the bank, that they want to go digital. Especially the small finance bank that exists today in India, they know that there is only so much capital that they can deploy for the OPEX. So if they have to grow, they'll have to put more money for the digital growth. So we have actually not faced much issue doing these integrations specifically for FD. Obviously, innovation took some time for us. And I believe not only big banks, but any mid-tier bank as well, all of these systems in place. Is just us and them finding the right reasons to collaborate onto the platform is what we are looking for. So once we are, and it's not only the 10 banks that we have, we are already being approached by 8 more banks that we plan to integrate in the next 6 to 8 months.
So technically, you have not faced until now any significant hiccups or friction in onboarding all of these banks that you have onboarded so far?
No, absolutely. In terms of technicalities, it's been seamless. Obviously, compliance check, infosec, all of that will take as much time as it needs. So that's the only time-taking process or a rate determining step. Other than that, technicalities, I think, is pretty seamless.
How do you make money at Stable Money by selling FDs and bonds?
Our eventual goal is to make money in long term by building trust and offering more products to the customers as per their need. But just on FDs, we make money where banks give us this commission to onboard some of these customers or to get new customers for the banks.
Okay, got it. Fine. So what are the demographic trends of the customers that you have onboarded so far in terms of their age, location, and any other details if you have and you can share?
This is very interesting data. So we have 60% of our users who have booked FD on Stable Money coming from tier 2 cities and beyond.
Okay.
Right?
Below, basically. Not
so tier 2, tier 3, tier 4.
Below tier 1.
Below tier 1, yeah.
Okay.
So that's a very interesting trend, very encouraging trend, because we believe that's the new to wealth customer. This is the customers whose wealth will grow at a much faster rate and who will need these products more than anybody else. Okay. Because these are the customers who can't afford to have a wealth advisor. Second is the median age of our customers, and this is surprising to anybody that I talk to, is 30, where everybody that I speak to, whether it's my friends, family, investors, people like you, people say that FD is a mostly senior citizen product. And you'll be surprised that only 6.7% of my users are senior citizens. And that too, a lot of people like us will go to their parents and say that book it on Stable Money. So my median age is 30, where we always thought that every young person would go and do stock markets, but that's not true. And 35% of my users don't have mutual funds. That's very
How do you get to know that? Like, how many of your users do not have mutual funds at
So
all?
one way of knowing that is by asking users for that data.
Okay.
So we keep running multiple surveys on our
Okay.
app. We keep talking to a lot of customers. Through that, we have figured out that 35% of our users, if not more, 35% at least, users don't have mutual fund, and remaining users as well, they have more money in FDs than in mutual funds.
Okay.
So that's been very encouraging for us, that this users is, as I said, right, new to wealth, and not only fixed deposit and multiple other products. Eventually, these users could buy mutual fund also from our platform.
Got it. So I'll add to that queue that you mentioned. So we did this recent study of 5 to 6 fund users of One Finance.
Okay.
And among Gen Zs, I think 67% of them are over allocated to debt.
Oh, that's very surprising.
I'll just give you the precise number as well. So yeah.
Oh, that's very
Debt.
interesting.
Yeah, 66% of Gen Zs are over allocated to debt, and only 17% Gen X. Gen X are basically the ones who took birth between 1966 to 1980.
Yeah.
They are just 17% of them are over allocated to debt. So just like you said, that surprisingly they are lesser senior citizens
Yeah.
who are coming on your
Oh,
platform.
this is even macro data then. Yeah, this is exactly how things are playing out with.
I think the data that we have is of digitally savvy audience.
Yeah.
But still, even if it is of a digital savvy audience, 66% Gen Zs and close to 40% millennials,
Yeah.
millennials are 1981 until
Yeah.
1996, have over allocation to debt, which is like beyond alarming. Not alarming as such, it's scary, but it's an insight that we never could imagine, right?
Yeah. Because I think whatever we talk, whatever we hear, whatever you see on YouTube, is everything very capital market. Nobody talks about this. Not even these customers would like to talk about their debt instrument. But another thing that we have to see, that this is mostly the Gen Zs and everything that you have mentioned who have debt allocation. You will realize one important insight, that Kanan, these are the users who have first time rich. And anybody who's first time rich, like I know that what situation we have been through. And if I am now start making money that my parents never would have thought about, I would be always risk averse, and your first preference will start going into debt.
True.
So that's very important. Though I consume capital markets and everything, but I will ensure that my basics are in check. I don't want to see that kind of a life again. So that's very important.
Well, that's true.
Yeah.
That's why there's a larger need of us educating people on debt products as well, right? So I'll come to another point of zero coupon bonds versus interest yielding bonds.
Yeah.
How are they better?
Yeah.
But before that, since you're talking about your users, what is the average ticket size on an overall base of your investors on your platform? Like, what is the average amount of FD that they book on your platform?
Yeah.
We can categorize into, say, top 10,000 customers.
Yeah.
How many customers do you have, first of all?
So we have around 18 lakh registered users, and we have around 1 lakh users out of that who have booked FDs on stable.
18 lakhs are the ones who have downloaded your app?
Who downloaded my app, who have registered, given their details.
KYC?
Not KYC, given their phone numbers and email address, logged into the app, have seen the platform. And we realize that most of these users take time. They will, over the next few months or years, they'll book. But 1 lakh users have already booked FDs.
Okay. So what is the average amount of FD that they've booked?
So on an average, I have 2,30,000 rupees
on
as
1 lakh customers
of these customers.
So that is how much? Like, I'll have to.
That's
count the
about
zeros.
2,000 crores.
Wow, 2,000 crores worth of FDs have been booked.
Yeah.
I was taking a smaller number, say 100 crores. Wow, that's huge. 2,000 crores.
See, and I think important thing here that everybody missed, even somebody who are building these fintechs, Kanan, is that people said, yeah, FD's commissions are low, absolutely, than what you get from mutual funds. But because it's such an old product, that so much of wealth has been already built on the fixed deposit. That's just the movement of the fund that is happening, right? So you will be surprised that 18, 19 crore users on who have FDs, and this is like 18-19 crores, that means you have long tail also. Average AUM per user is 3.2 lakhs in India. And that's why we say that 60 lakh crores is worth retail investments. So there is a large amount that sits into FD, and that part is moving so to us. And we also believe that this number should go significantly higher, because of these 18-19 crores, you will still capture the top 5, top 10% of the users, where the average ticket size per users must be much higher. So yeah, that's the number that we have right now.
Well, 2.3 lakhs is on a 1 lakh base, but what about the top 10,000, 25,000 customers?
Oh, that should be, we haven't looked at it that way, but we have, it should be around 10 to 15 lakhs.
That's huge.
That's huge, yeah.
Great. Coming back to the question of, there's this company which offers 11% return on its bonds.
Right.
And post-tax, I get 9.9% interest.
Right.
And I've gotten a bank loan on my car, which is of around 8.95% interest, and post-tax it comes out to around close to 6%, because it's a business expense for me. So this delta of 3 to 4% covers up for my maintenance cost, and even beyond that, insurance, maintenance, everything. So I'm at a very huge advantage over here. But if I had to do this with an interest yielding coupon bond, the problem that would have arisen would have been that there would have been very less delta, because I would have had to pay 30% on the interest as well, and it would not have compounded either.
Absolutely.
So do you have any plans of listing ZCBs first of all on your platform, and how are interest yielding bonds better than ZCBs, if at all they are?
No, I think ZCBs we plan to do. The only thing is, a lot of good branded companies right now are not doing ZCBs. Second is, I think why we are also doing interest coupon bond, and especially not the bullet bonds. We are trying to do a monthly and quarterly payout bonds, is because, see, bonds is a new product. This product is not very well understood with the customers. Now, if I sell a 1-year product or a 2-year bond, people will wait for that bond to get matured, for that money to hit their bank account, to start building trust. Now, how do you short circuit this trust? Is by doing a shorter tenure bond or a monthly quarterly payout bonds. And that's our focus, that I will sell to my customer monthly quarterly payout, so that every month they'll start seeing the money. That builds trust, and once they start building trust is when they do more and more transactions. So that's our primary focus. But I think these are some of the bonds that we plan to get once we get full-fledged into bonds as a product for everybody. ZCB, as you said, it obviously makes sense, but obviously we'll have to ensure that it goes through our risk checks.
Got it. So speaking of companies that list their bonds, so there are typically two types of bond listings that happens. One is public listing, for which you have to be a public limited company, and it comes with a huge cost. So someone like a Mannapuram would get the bonds listed.
Now we did public listing.
Yeah. So for them, it's at their scale, it's understandable. But for a lot of companies, they can't afford that. So there's private placement of private limited company bonds, right? Now that SEBI has cracked down on unlisted bonds entirely, and no online platform can distribute unlisted bonds in any manner.
SEBI has actually recommended to customers to not buy.
Unlisted
there are
bonds
platforms which are still offering unlisted, but SEBI said don't buy.
Yeah, and SEBI is penalizing them.
Some of these users, yes.
Right, and they eventually, if someone scales, SEBI will pull them up. Right?
Obviously.
So
this is the first step towards that.
Right. So let's say that unlisted bonds are not allowed, because SEBI will ultimately pull them up. So which is fair also, because they come with a huge set of risk, right? So why would a company still not want to get listed, like at least their bonds listed? Because not only it helps them with these regulatory checks, but also they can get a lower interest rate, because once the bonds get listed, there's an inherent sense of confidence in the users that fine, they might get bust, but there's still a lower chance than buying an unlisted company bonds. That's number one. And when there's price discovery, of course it is not as good in Indian debt ecosystem as of now, but still it's better that they there's still some level of price discovery mechanism. So the bonds get cheaper that way as well, like for the company, for the issuer. So why would a company, like apart from compliance cost
Yeah.
and listing cost, why would a company still not want to list their bonds? I'm asking this question because through this answer, we want to send a message to the regulator to ease up the process
Right.
of and increase the incentive of companies getting their bonds listed.
Yeah. No, I think already regulator, and you are right, regulator is already doing a lot of effort by cracking down on unlisted bonds to make sure that people keep moving to the listed bonds, and you'll see more and more momentum on companies going to listed bonds. Other than compliance issues and everything, I think the major reason that we also see is the requirement. A lot of these unlisted bonds which are getting issued, their requirement is not significant. Plus their requirement is so frequent. And the third angle is the business that they are into. Even that slightly higher cost of capital makes sense for them, because they are either, if they are doing future lending that comes at a significantly higher interest rate, so their names are better or whatever. Right? So there are multiple reasons for which companies today don't see the need of getting into listed, because if you have to get into listed and if you have to do so frequent issuance, that will be a problem. You want only, let's say, 50, 100, 200 crores of capital. Why to get into listed things? Because the compliance continues for a long period of time. And second is, okay, I understand that I get it at a 1 or 2% slightly higher interest rate because it's unlisted. My business unit economics still makes sure that I'm making money. So why to take that hassle right now? But I think you will see eventually more and more companies moving there unlisted sites.
Got it. Now speaking of these bonds, do you sell them at a markup, like after buying them from secondary market? Are you selling them at a markup?
Some we sell at a markup. Most we sell at price. Some we actually also put in more money from our pocket to sell it, because you want to create awareness. Like for example, T-bill, it's a 6.7% bond. We sell it at 8%.
Oh.
Right? So, and because we want our customers to try their first bond, which is 100% secure, you get 8% for a 1 month or 2 month T-bill bond. So these are different strategies for which through which we work.
Okay, got it. So speaking of banks, like typically of the top 10 banks that you have onboarded so far, how much kickback do you get from them for every FD that you book for them?
It is very different for the size of the bank and the requirement and all of that. And the range goes from let's assume 15 basis point to almost 50 basis point.
0.15 to 0.5%.
Yeah.
Got it. Fair enough. Now coming to the last question, like we of course spoke about your personal portfolio mix,
Yeah.
but if we have to speak about a 30-year-old who is investing for long-term goals, like say investing a house 15 years down the line and for
Yeah.
retirement at the age of 60,
Yeah.
what should their debt mix be in their portfolio?
See, I think it's very difficult to, and this is the problem that we have identified before coming to an answer, right? And how I'm also constantly thinking about, if somebody asks for this advice, what do we give as an advice? For a 30-year-old, most of the users are seeing themselves for the next 3, 4, 5 years only, because that's only the visibility that you have, right? And let's say Kanan's next 3, 4, 5 years will look very different from my 3, 4, 5 years.
Correct.
And the major reasons is we are at a different stage. But Kanan's 30 year in future will have a very good overlap with my 30 years in future.
Right. That's what I'm talking about. Long-term goals.
Yeah. So, but I'm just saying everybody is giving advice for a very short term.
Right.
And there is a very beautiful product which is called Vanguard 2040, Vanguard 2050 that exists in the US, which has averaged out this and said that if anybody is earning till 2050, when anybody is earning till 2060, this is only one product that you have to invest, because you don't have to get into the complexity. That fund builds your emergency funds in the initial few years. That funds increases your equity portfolio and then start dropping it as you come closer to the 2050, 2060. And that's the right thing, because there is no case in point investment that makes sense. So let's say, for example, anybody who is 30 year and doesn't have an emergency fund, I would recommend him in the next 1 or 2 years to first build the emergency fund. That has to be somewhere between 12 to 15 months or 12 to 18 months of your income. People say 6 months, but 6 months is very case in point. By the time you will need that emergency fund, your expenses, your family, everything will be large. So you'll have to do that 12 to 18 months calculation from now. And as you keep moving upward, I think your equity portfolio should start with a 65%, 35% debt, 65% equity, and that number of equity contribution over the next 20, 30 years should be keep dropping to 10 to 15%, and your debt portfolio should keep going up.
That's 100 minus age rule if you're talking about. Got it.
So that's the rule. The only thing is we don't do this comprehension so easily. There has to be a product that is solving it for you, because we are not like, there are people who are doing investments as a job. These are the best people to do that. And we are talking to the customers, or stable money's customers are the customers who wants to make more money by earning more money, and there is a difference. When I make more money by earning more money, that means that user has aspiration to open more shops, to do better education, to get a better job, to get promotions and all of that, right? That user will not spend this time doing this calculation and doing the investment. And that's why these people do a lot of mistakes and forget, because they hear something, they see some video, they do the investment and then they forget. But they don't know what's going through the market day in, day out, because they're doing something else. So this work has to be done by the professionals. And having a wealth advisor as a professional for this TG is very costly and it's not effective. That's where we are trying to build a product in long term that this takes care of your entire requirement.
So do you also plan on onboarding distributors or intermediaries on your platform?
We plan to. The only question that keeps coming in our mind that there is a potential to grow the business with that. But how do we solve for the incentives of the intermediaries? Because incentives are so aligned that the great product is not sold to the customers. So that's the only risk that we see of getting intermediaries. One way to solve that is most of the users or intermediaries that you get are on your payroll, which makes the company very bulky. And other ways is get some of the already existing intermediaries onto the platform, but you have to make sure that the mechanism and incentives are rightly aligned for the intermediary and the customers as well, which is a very tricky task right now. So we definitely plan to do that, but not for the next 1 year.
Okay, got it. Any closing note, Saurabh, about this conversation that we had about your plans for building for India, and how do you see yourself, the company in the next 5 years? Of course, I know it's very turbulent in a startup ecosystem, but what all do you see stable money offering, and how large customer base do you expect to have in the next 5 years?
I'll talk about the company, but I would like to talk about some of the work, Anand, that you're doing, and this conversation I really enjoyed. I always enjoy reading your magazine that gives very great insights. Sometimes it's very counterintuitive, like what you gave as an example on the debt investments as well, right? So I think there are a lot of insights that come out of that, which is helpful for me and my business for sure. So
thank you so much.
We are a very regular reader of this. About the company, I think for the next couple of years, we are very clear that we want to keep our products and our customer very concentrated to debt. I don't want to show any negative returns to my customer at any point in time. And we will go extra mile to ensure that even if that makes more business sense for our business, we will not onboard such banks, products onto our platform, which is riskier, the product that we don't understand, the product that I can't sell it to myself or to my parents. We'll try and avoid those products. So that's our plan for the next couple of years. Acquire these customers from tier 2 cities and beyond to make sure that they build trust onto the platform and give that incremental wealth to those customers, that the opportunity that they don't get right now. That's our focus for the next couple of years. We have seen with enough and more companies now, once you build trust with the customers, I think growing that business becomes very, very easy. So initial couple of years looks very tough, and we are going through that tough period where you have to take the choices where you focus on customer trust versus business. I think we're taking a bet on trust, and we are very fortunate to have some of our investors backing us to keep investing in building that trust. So that's the place right now.
So one follow-on question to what you said. It becomes very difficult. I'm sure you are doing it well, but I want to understand the how of it. Because when you are selling products that inherently come with, a higher commission,
Sure.
it incentivizes any business, any individual who's a distributor to sell products which are higher commission linked,
Sure.
right? While you spoke about trust, that's what you want to build.
Sure.
But how are you able to manage that inherent conflict which every business
Sure.
has versus that of the long-term vision that you have of building trust?
Sure. I think a couple of things that we do, that every product that we have on our platform is invested by me, my co-founder, my team, my family,
Wow.
and company's money as well. So the bonds that we purchase, our company's money is invested into those bonds
Okay.
also. So anything that we don't buy, we don't want to give
Sell
it
to
to
your
our
customers.
customers. So that is one thing. Second thing that we do is we talk to 800 customers every day, Kanan. So we have our customer support team. You will see these people are constantly in touch. So there is a lot of reality check that keeps coming in to us, saying that why are you doing this, why are you not doing this, and how did you do this, you didn't inform us about this. So I think that keeps us moving very, very fast and keeps us on our toes and grounded, saying that okay, these are the things that we can't do, because our customers on the next day will pick up the phone and call us and tell us this. I am personally connected to almost 700, 800 of my customers who ping me on WhatsApp, hey, this is not working, this is working, why are you doing this, why are you not doing this, kind of thing. So I think that keeps us on path to what we want to do.
Great. So thank you so much for your
Thank you,
time, and it
Karan.
really means a lot to us. And it was a really insightful conversation. I really enjoyed discussing this with you.
Thank you so much.
All
Karan.
the best for future.